Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi, my name is Ray, and I am a senior investment strategist with Standard Chartered Bank Chief Investment Office. And welcome to this episode of Through the Noise. With me today is Manpreet Gill, our CIO for Africa, Middle East, and Europe. We have just published our February Global Market Outlook, and I would like to take this opportunity to ask Manpreet to share the latest market view for us. Manpreet, now, about a month since Trump took office, and we have seen an announcement of the tariff already. Are we past the worst in terms of the tariff announcement, or do you see a risk for inflation, Fed cuts, and equity markets?
Hi, Ray. Thanks so much for having me today. It's certainly been an interesting time. And from a market perspective, I think what's interesting is that Trump's initial weeks as US president have been far less disruptive than many people in the market had initially feared. Now, equity markets have continued to climb despite tariff announcements so far, and bond yields have remained relatively restrained. Now, the debate on the risk of inflation from Trump's policies does continue because his tariff plans are arguably inflationary, and we also had a US inflation data edge higher in the latest data release. But in our view, on balance, we think that still leaves room for the Fed to cut rates further, but we do dial back our expectations slightly to just 2 rate cuts in 2025 from our earlier expectation of 3. But from a market perspective, if I step back and look at the bigger picture, we remain comfortable with our preference for equities, particularly relative to bonds and cash. And look, even our long-term quantitative models point to further gains in equities. While sentiment and investor positioning is admittedly quite bullish, we believe a catalyst for a significant pullback so far remains absent. And that's a view, of course, supported by what's still a pretty positive signal from our short-term equity market model. So overall, we wouldn't be too concerned at this time.
Thank you, Manpreet. Now, moving on to a little bit more on the equity side. So within equities, one surprise that I think that has been the relative outperformance of European and China equities, and also the underperformance of the Indian stock market. Do you think these trends will likely to continue?
So in our view, we're not really convinced that those trends can continue. And we'll go through them one by one, right? So on Euro area equities, the recent outperformance has arguably been driven by a partial reversal of what was extremely bearish sentiment. And of course, we have the optimism over a potential end to the Ukraine war and some expectations the upcoming German election could lead to a significant revival in fiscal spending. But in our view, if we have to get sustained outperformance of Euro area equities, that would most probably require a pretty strong catalyst. For example, a credible plan to expand Euro area fiscal spending, and potentially would require a weaker US dollar. And for now, at least, these two drivers don't seem to be in place. On your second question on China, here we're similarly circumspect on how long the relative outperformance can continue, because we obviously got a lot of market optimism sparked by the emergence of DeepSeek, and of course some related signals that policymakers are tilting towards reviving growth. However, US tariffs do remain a threat. Significant fiscal stimulus so far has not been forthcoming, and bond yields suggest deflationary pressures have not completely abated. So for Chinese equities, I think our preferred approach is to continue to add, but more so on our focused opportunistic ideas in Chinese equities. And finally, on a third question on Indian equities, we are of the view that the pullback is likely temporary. We've slower growth and earnings data, foreign investor selling, and some concerns over the impact of US tariffs are most probably what's driven this correction. But let's not forget that, correction in the region of 10 to 15% are not that uncommon for Indian markets. And, actually valuations have now eased back closer to their 10-year average. Consensus estimates suggest earnings growth is likely to improve from here, particularly given some of the policy stimulus we got. So we're more biased to see this as an opportunity to buy the dip. So overall, I think where that leaves us is that, we still sort of are of the view that US equities have room to outperform amongst major regions, and Indian equities room to outperform within Asia, Japan on a 6 to 12 month horizon. So for both markets, we really would buy the dip.
Okay, thank you. Next on, I think the dollar. Let's talk about it a little bit. It has to be seemingly trending a little bit low recently. I guess, where do we see the dollar right now and how the US bond yield is moving from here in your view?
Well, I think when it comes to the dollar and US bond yields, both seem to mirror each other to a large degree. So the dollar has softened as you described, and I think that's mirrored what has been a moderation in US bond yields as they pull back from the most recent range highs. Now, in our view, both US bond yields and the US dollar are likely to largely trade in a range from here. And I think that's driven to some degree by where we started today's conversation about what's still a somewhat unresolved debate on US inflation. Because US tariff policies, immigration curbs, and what we're seeing on the growth data are likely to keep the inflation concerns alive. But wage growth is still contained, and cooling shelter inflation should, in our view, ultimately keep inflation data in check. And as we described, we are of the view that we'd expect two Fed rate cuts this year. So all feeding into more of a range-bound view. Now, the one thing I'd add is that within bonds, the inflation debate, the still stable growth outlook means we actually see the most attractive risk reward in developed market high yield bonds. Credit spread valuations are admittedly not cheap, but when you sort of look at the context of still strong growth, high credit quality, we just think those credit spreads can stay quite tight, and that's why we're overweight and think it's a good opportunity to add a small tilt and earn that higher yield.
I see. Now, gold has also performed very spectacularly year to date. Manpreet, do you think it's too late for an investor to add right now?
Indeed, it's been almost relentless in the rise in gold prices. But the relentlessness has meant that we've actually achieved what we set out as a 12-month price target in our annual outlook in less than 3 months. But we're still sort of optimistic on the next 6 to 12-month horizon. Now, data so far suggests that the gains we've seen so far have been led by a combination of strong central bank purchases and concerns about inflation. Now, we believe these trends can continue over a 6 to 12-month horizon because central bank reserve diversification, in our view, has further to run. And of course, if we get any short-lived equity market volatility or demand for inflation-protecting real assets, we think those, of course, can be additionally supportive factors. So we're still positive and overweight on a 6 to 12-month horizon. I will say, though, that the pace of gains in recent weeks, coupled with what is now stretched investor positioning, suggests that a temporary pullback in prices is likely, most likely towards $2,800 or slightly below that. But of course, that's a dip we'd be very happy to buy, because if the drivers of gold prices indeed remain unchanged, that kind of shallow pullback would be, in our view at least, an opportunity to add exposure.
Thank you, Manpreet. I think, our key takeaways on this will be, number one, stay long on U.S. equity. Number two, buy gold on dips. And three, stay the course for DM high yield bonds. Thank you all. That's all the time we have for the week. And thanks for joining again, and look forward to speaking next week. Bye.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.